broadcasting live from the Commonwealth's 2023 National Financial Advisors Conference. We're at the Gaylord Rockies Resort in Aurora, Colorado, a world-class water park, I will report, for those that are into the water park thing. What we're doing here, there's a lot of registered investment advisors here. People manage money for others. They gather here along with their platform, the folks at Commonwealth. Matthew Jessup joins us. He's the CEO and managing partner of Jessup Wealth Management. So, Matthew, you've been in this business a long time. You started at UBS Wealth Management.
Correct.
Then you go off to form your own firm. Why do you go off to form your own firm? And talk to us about, what it was like building that business.
So, Paul, when I got started in the business, that was back in the day of, cold calling, right?
Yep.
Smile and dial. And I was able to build, a client base. And in the late 2000s, you go through the GFC, the last thing I wanted to worry about is the custodian where my money was held. And, being independent gave me the ability to invest money the way I wanted and grow the business in my fashion. And it's worked out really well over the years. We're managing over $300 million of assets, over 400 households across the U.S.
So how do you build that business? What are some of the tools you use to build that business?
So, a lot of it is going to be word of mouth and referrals. I do it old school now these days. The days of smile and dialing is obviously over. But, if you look at, how the business has grown, it's mainly through that word of mouth through our entire client base.
In terms of what you do to get your message out there beyond word of mouth, I'm thinking about social media, posting on Twitter, for example. Yes. Bailey was just talking about putting charts up there. Or maybe even going a little bit further, a YouTube account or a podcast. What do you think are the best bang for your buck ways to spread the word?
Matt, great question. For us, it's going to be our podcast. So we started the Independent Advisors podcast. We've been doing it for 222 consecutive weeks. Each of those podcasts last about 30, 40 minutes. And what we do is a really good job of educating our client base and potential clients. We're going to talk about big news and headlines over the past week. We're going to highlight, tweets or X's, articles, and research. And then we do financial planning topics of the week. And this was started with me and my business partner, Mark McEvely, who is our firm's chief investment officer.
So what do you find that your clients need the most these days? I mean, if you kind of just lose yourself in social media or in the news, it can be dizzying. So, how do you try to get your clients to focus on?
At the end of the day, it's helping them meet their long-term financial goals and avoiding the short-term noise. And if we look at the market day to day and react to that, we're going to get them off base. And so I think we do a good job putting the news headlines into perspective. Let's take geopolitics as an example. If an investor was waiting for the absence of geopolitics, they never own stocks.
Right.
And so I think we do a good job managing and balancing what they're seeing day to day in the markets, Paul, and managing that with their long-term goals.
So how do they think? Everybody's different. Everybody's got different goals here. When you start off the conversation, kind of where would you like to take them for most of these people? Is the 60-40 portfolios still the place to start, or is there a different place?
For a lot of retirees, I think that's fine. I think that the 60-40, due to the way the market was in 2022, is getting a bad rap lately. Yep. We don't think it's dead. I think ultimately, the way our firm manages money, we don't sub anything out mainly to third parties. We're using individual securities. We do our own research, and we have our own in-house trader. And right now, I know we're going to get to it in a little bit, we're overweight equities right now. We have a different contrarian view than Wall Street right now.
Why?
Well, ultimately, we think that Wall Street is too pessimistic right now. I think when you look at a lot of the indicators, Matt, it could be everything from investor sentiment, or you look at a lot of the extreme ratios we've seen over the past year. I think the market can't get around the fact that stocks can do good in higher interest rate environments. NYU did a great study that looked at 4 variables: rising rates, falling rates, rising interest rates falling, with inflation on the other 2 variables. And when you look at those and all those scenarios of falling interest rates and inflation, ultimately stocks only do bad in one of the 3, and that is going to be a rising inflationary environment. And ultimately, we are seeing inflation come down. It's not going to come down every month. We know that data point just recently. But we're making a lot of headway, and these Fed rate hikes take time to work theirself through the system.
Yeah, fair enough. Hey, I want to know about your take on the long end of the curve here. I think a lot more people have been learning about it. Certainly, we've seen massive inflows to TLT, which is a 20-year plus bond fund, ETF. And And one of the things that I think people are noticing is small moves in yield contribute to very big moves in principal on the long end. But a lot of your investors, a lot of your clients may be looking at, say, the 30-year at 4.75% and saying, I don't care about moves in the principal over the time because I'm going to hold this to maturity. Those rates look juicy. Are they going to look juicy when we look back in 10, 15 years?
Well, Matt, I would kind of take the other side of it. Right now, we're on the short end of the curve because the big concern for us is ultimately rates are going to come down, we feel, over the next couple of years. And what we're going to look for is a definitive move in consistency before we start locking in some of those longer-term rates. Now, I don't think I'm unique in that feeling ultimately, but I think at a certain point, owning individual bonds for our clients takes away a lot of the risk that you just mentioned, sir.
All right, so Matthew, talk to us about some younger investors. How do you go out and try to attract younger investors? Because a lot of folks are just concerned that maybe they're not saving enough early enough. Maybe they're not, because they have a lot of challenges, whether it's student debt or other things. How do you approach some of the younger investors out there?
Great question, Paul. So you and Matt were just talking about, presence on social media. If you look at these next generational investors, they're looking towards professionals that can guide them and provide that advice, but they want to connect on a personal level. I'm at a firm where I'm the oldest team member in my young 40s. So what's great is me and Mark have built up a great team that can sit down one-on-one with these younger investors who can relate to them, right, to their goals that they're dealing with. And so I think that's a good thing, is that ultimately we can relate on a one-to-one basis in multiple levels.
And what do you think do they want anything different in their investments than maybe some of the, I don't know, the baby boomers or just some of the older investors?
Great question, Paul. They're more risk averse, believe it or not.
Oh, okay.
So what we find out is that investors in their 20s and 30s, they're not having experience yet in investing into equities. And so what we see at a lot of times is we are spending a lot of time educating them, Paul, up front on risk, reward, volatility, goals and objectives. Because ultimately, with the time horizon they have, they're going to be very much benefited by having that equity exposure. But then we have to get them past those day-to-day and month-to-month headlines that might derail that bigger plan, if you think of it
And
that
it's
way.
interesting. I mean, the younger investors now, fixed income is actually an option. There's a generation of people who have had nothing but zero interest rates that have had to go out and take more and more risk, whether it's equities or alternatives. Now, fixed income can really be a percentage of your portfolio.
Absolutely. I mean, I think, going back to Matt's point about at some point, you got to start thinking about locking in some longer term rates. While we have these great short-term rates, you got to go out and enjoy that. It's time to harvest. But at a certain point, I think over the next, say, 6 to 12 months, looking at longer durations is probably going to make a lot of sense.
What are you hoping to gain from this week here at this conference?
First and foremost, easy question, networking with my peers.
Yep.
That's where I get a lot of good information, best practices. We're not here to reinvent the wheel. And so I have a good group of like-minded individuals that we network with. We have a great study group of about 10 other advisors that me and my business partner, Mark, we meet with, and we share and get a lot of good ideas on how to run our practices.
All right, Matthew, thank you so much for joining us. Matthew Jessup, he's the CEO and managing partner with Jessup Wealth Management.